this computer. And it says we are recording, so no profanity, no inappropriate. No, I'm just kidding. Say what you want. Hey Dan, how you doing, man? Thank you so much for agreeing to do this. I know you're extremely busy. So yeah, do you want to just tell people a little bit about yourself, a little bit about your background, first of all?
Yeah, sure. So yeah, thanks for having me on. I appreciate it. So my name's Dan. Been in the real estate business. This is my 5th full year. So I'm an investor and also a real estate agent. So I do both. I have a sales business where I help people buy and sell homes, and then also I'm active as a real estate investor myself, mostly as a passive real estate investor. So that's kind of where I'm pushing long term for my career to go because there's more opportunity to build wealth there. So that's what I'm mostly interested in. But it's a nice synergy because the sales business provides me the capital, which you need, right? You need some money to invest. So that's what it's there for.
Yeah, absolutely. And you're here in Las Vegas, Nevada with me as well.
Vegas. Yep, been here 8 years now.
Okay. I got to ask you, seeing as I mentioned earlier, you have a really nice suit on. How do you cope when it's 100 degrees out in the suit? You just run to your car?
Man, I just suffer through it. But yeah, I'm a big believer in your appearance and how you dress, and you'd be shocked, man, the conversations that start. And actually those 3 condos, I was telling you about those condos that I just put under contract.
Yeah.
This dude I met in the airport, I was on the phone with a seller and he heard me this guy overheard me talking to some client, I guess. He's like, dude, it sounds like you're a good salesperson. What do you do? And it started the conversation. He saw the suit I was wearing, so he asked me about that. And then he ended up introducing me to this guy that I'm buying the condos from. So just goes to show you like that. But yeah, I'm a big believer in dress to impress, because you never know who's going to be around.
Wow, so that's fascinating. So you were just literally talking to a seller on the phone, and someone approached you, and that's how you got those 3 condos?
Yep, that's how I found the deal.
Wow. Nuts. It just shows you with real estate, if you're just active and you're just doing your thing and you're just doing it, that deals will show up and things will happen if you're just doing your thing. You just got to keep doing it. And obviously, so do you dress like this everywhere you go? You always wear a suit?
Yeah, I mean, not on weekends. Like I have some off days too, but
yeah,
during the week, yeah, 5 days a week. Sometimes on Saturdays too when I'm working. So I try and be real consistent. Even when I know people, like if I was showing you properties, I'd wear the same thing because I don't know. As a salesperson, this is different from being an investor, but as a salesperson, I feel like I need to treat all my customers the same way. So that's just kind of how I run my business.
Yeah, absolutely, and I can absolutely see that you project an appearance, and also you can talk the talk, and you can back it up with your work ethic as well. So it's just all the packages in it that brings people to the table for you. So yeah, cool. So do you want to talk? You mentioned it there. We might as well just go. You told me over text about this. It's 3 condos, right?
Mm-hmm.
That you recently just have you purchased, or you're under?
We're under contract right now, actually today.
Okay. Do you want to tell us a little bit? Can you talk about it, or is it a little too?
Yeah, absolutely. No, I don't mind. Okay. So I like really passive real estate investing. That's my primary thing. For me personally, I always ask people what their goals are as an investor, because for me, I already have an active sales business. I already work a lot. I work 50, 60 hours a week. Mm-hmm. So I'm not looking for another job. So I don't do a lot of flips. I do mostly, passive rental properties that I can just buy that just churn cash, that allow me to write stuff off my taxes, and it's just easy. So yeah, these condos work really well. They're in the Northwest. The cash on cash isn't great. Like I told you, I think it's around 5% cash on cash. I'm putting 25% down. Really, one of the main driving factors of me wanting to get into properties now, and a lot of people aren't, is because of the debt and the interest rates being so low. I think it's such an under talked about thing. Like I'm getting a 3.6% rate on these for a rental property. It's like nuts. That's like, crazy. Yeah, you're typically looking at like 4.5, 5, which has been normal for like the last few years. Like I have great credit, and I was paying 4.5, 5%, 5.5%. So just to get something locked in with that good of debt long term that I can just have as an asset in my portfolio in a good location. It's up in the Northwest near Providence, where the zoning is really good. It's around a bunch of new construction, really close to a Starbucks and a Whole Foods, which I look for. Or actually not Whole Foods, just Starbucks. But yeah, that's that.
That's great. That's great. So there's a lot there. So to start off with, so are all the condos in different areas, or is it part of all the one building? Is it the same HOA community?
Yeah, all in the same one, which makes me a little nervous. I've never done it before, just because it's, one association, you're owning three properties, there's more risk if something goes wrong with that association. So
True.
I'm looking really, really closely at the HOA rules. We're ordering them today, actually, to get them before I do anything else. Before I spend any money on inspections, anything like that, I'm going to review all that. And specifically, what I'm looking for is I drove by the property this weekend to look at the condition of, like, I want to look at the paint of the buildings and the condition of the pool to see, like, is there any, um, what is it, the repairs that have been ignored for a while. I'm blanking on the term for that right now.
Deferred maintenance.
Yeah, deferred maintenance or anything like that. And it was in pretty good shape, but I'm going to look specifically at the financials, if there's been any assessments recently, if the dues have increased, things like that.
Yeah.
So,
So yeah, maybe you could talk a little bit because if you go on Bigger Pockets a lot of times, and in general, people say that condos are, excuse me, condos are terrible investments. That's kind of the blanket statement that people make, right? But it depends, right? It's just like anything. You have good investments, you have bad investments. So for one, why do you like condos? And then secondly, maybe you could talk about if people are buying a condo, what they should look out for. What are the pitfalls? What maybe
yeah,
they
great
go in.
question. Really good question. And I mean, I actually agree as a general rule, I don't like them either. I'd rather buy single family homes. But I'm in a specific scenario where I have money that I want to put somewhere where it's earning some kind of return. And as you know, we're in a market here in Vegas that's tough for an investor. It's the rent to price ratio is not great right now. So yeah, I agree. Condos don't hold their value as well. They decrease in value more quickly than single family homes. There's more risk because you can't control the association. And even though, single family homes have associations too, but it's more significant with a condo because they're overseeing more stuff. So for all those reasons, I like single family homes better for sure, or townhomes even way better than condos. Another big reason I like them better is because the financing is easier. So if you ever need to sell, it's way easier to sell a single family or a condo or a townhome because it's way easier to get financing. Condos are a nightmare to finance. But all that being said, like
Well,
you said,
yeah.
but, there's no black and white in real estate investing, right? There's like people who say never buy a house with a pool. Well, it depends on the deal. Like if there's a good opportunity, it could make sense. So, yeah, in this case, it's a really good location. It's the number one reason I'm interested in it. It's a part of town that I'm really bullish on that I think is going to do well long term. It's newer product that in an association that's pretty well managed. And you asked, like, what things do I specifically look for? Yeah, the first thing I would look at if I was buying a condo would be what the HOA fees are, what they've been historically, if there's been sudden increases, and then really the main thing is driving the property. What kind of feel do you get? Do they enforce street parking? Are there cars just like on concrete blocks sitting in the middle of the road somewhere? Is there a lot of deferred maintenance in the pool, paint, things like that? All things to look for. And then asking tenants too. I love doing that. When I drove this weekend, I asked some of the people that live there, hey, I just drove up to them and asked, like, hey, how do you like living here? What's it been like? Because there's no way to get the unfiltered truth until you ask that.
Yeah, I think that's a great point. I always, whenever I bought any house, or even if I'm looking at an apartment building, you just ask the neighbors or people living there. They have no reason to lie to you. You're always going to get a real good picture of how things are. They'll say, oh, it's terrible here. They don't take care of this and that. Or they'll tell you, oh, this is a great area. I love living here, and that gives you an immediate insight into what the area is like. So I think that's such a great point. Now, with these, so there's three. Did you buy them with one loan, or did you have to get three separate? Did you get a blanket loan, or did you manage to get?
No, I'm doing three. I'm actually talking to my lender about it right now. I'm doing three separate ones, which kind of sucks. And the government's limiting me on my loans now. These are my last three that I can get.
Okay.
My last three are mortgages. So I'll have to figure out after that. They cut you off at 10. So after that, you got to do, I guess, commercial or something else.
Yeah.
But yeah, just three separate loans, pretty much like three transactions.
Okay, cool. That's exciting though. Congratulations.
Thanks, man. Yeah, we'll see if it works out. Like I said, the main thing is I just want to be real careful with the association, just because what can happen with condos is if there is that deferred maintenance, if the association's not handling it well, really the root of the problem is they're not proactive enough. So some associations won't be proactive enough. They don't take care of stuff early. So it builds up and then it costs more because you waited too long to fix it, right? That stuff happens in everyone's life, but it happens in associations. So when I see a lot of that deferred maintenance, it makes me a little bit worried. So we'll see what that situation looks like. But yeah, really the main reason you asked, like why this deal makes sense to me, it's really the value. This guy, like I just mentioned to you, it's not an on-market deal where I'm paying retail price. I'm getting really good value on it. He's doing it a 1031 exchange and needs to liquidate some of his assets quick. So it worked out well for me. I'm getting good value in the cash on cash returns there. So it makes sense. It balances the risk of that association issue where even if the association went to complete shit, I would, pardon my French,
You're fine.
still, it would still be hard for me to really lose money in this scenario.
Yeah, yeah, and it's so dependent on each individual investor's investment criteria. Because you touched on a few things. One, which is a fantastic point, is the debt. If depending on how long you're looking to hold on these on for, it's hard to imagine at any point in the future that you'll get much better debt on it. With a 3.6% interest rate on an investment property is just unbelievable. It's almost like free money. So it's just, you're locking that in for 30 years, so if you're holding this for 10 years or more, or 20 years, however long you're holding it, it just makes absolute sense. And then another really interesting thing is that you said is that your main focus is to make the money in your as a realtor, as a real estate agent, because that's where you can make a lot of money, and then to invest that passively, as passive as possible, and make some kind of return on that money. That makes absolute sense, because I always hear the same with doctors and dentists and high earning individuals, that their main focus should be not a twoplex somewhere where, you know what I mean, they buy for 80,000 or something. Is to make as much money in your job and be as good as you can in your job and make as much money, and then invest that money passively, because where is your time better spent? Are you going to be better being actively managing these properties and fixing toilets and what I mean, putting new kitchens in or whatever it is? Or are you better going out there and selling properties for people, or bringing buyers to the table and making that money there? And I think that point is missed a lot by so many people, because so many people talk about real estate investing and that you need to be making a 15% cash on cash return, and otherwise you're kind of wasting your time. But it's not the case at all, because you're proving that, and you're building your wealth with these with this portfolio. Now you said you'll be at 10 properties, which is a great achievement, but at the same time you're really active in your day job, and with that, we're here in Las Vegas, which I think is a very interesting market right now. We're what is the date today? It's June 15th today. Do you want to give a little bit, just as hopefully this is going to go nationwide, but just a little bit of a tidbit as what's going on with the market here and how you feel about things?
Yeah. So, and I mean, excuse me, it's, I think, pretty similar here in most major cities in the US. We're kind of seeing the same effects, I would say. But yeah, it's a really low inventory market. Basically, we're talking June 15th, the worst of the coronavirus issue that kind of peaked March 23rd. That's when we went into a state of emergency, at least here in Nevada. Mm-hmm. So that's before March 23rd, we were seeing the supply go down and the demand go up like this. March 23rd hit, and then you saw that like reverse real quick, right? Like the supply started instantly, overnight, supply started going up and the demand dropped. But now we're seeing that come back to like where it was before. And that happened pretty much week over week since then. It started to rebound and get close to normal. Prices here haven't gone down at all. It's tough with statistics like this because you can look at the same numbers so many different ways. And a lot of people said, well, the prices did go down in April and May. The list prices went down. But if you look at the actual closings, the average closed sales price in May was up from the median, I think, was 285, went to 287. So that's at least what we're seeing right now. In the last week, and just to give you an example here in our market, in the last 7 days, there's been 800 properties that came on the market and 1,200 that went under contract. So that's pretty crazy. And it's kind of hard to believe, right? It's like, how is that happening? And I think a lot of people were surprised. But that's what we're seeing right now. Supply is going down, demand's going up. That might be a pent-up demand thing from people that couldn't move in March and April maybe, and they're coming into the market now. And then the government also took unprecedented action with the amount of changes they made to the interest rates, things like that. But who knows? I mean, in the next few months, we'll see pretty quickly, I think, what the trajectory is going to be in the next couple months if things fizzle out or if they kind of continue on the same path. What do you think?
Yeah, it's such an interesting topic to me because, you think Vegas more as much as anywhere else would get hit because
Yeah, we were
tourism,
the most exposed of any market for sure.
yeah, exactly. Because tourism has to be one of the hardest hit sectors because if you're struggling to make your car payment and your house payment, the last thing you're going to do is think about going on vacation, I imagine, right? But I think one thing, like you mentioned, on is the stimulus money. I think a lot of people are making out better than
Yeah,
were before.
yeah, yeah.
The extra 600. Now, the interesting factor is that when that comes to an end, I think it comes to the end, supposedly the end of July. There's talk of they might extend it or they might do something else. But I think that's, for me anyway, the X factor is what happens after that runs out. Do people have money saved? Are they able to go back to work?
Right.
So yeah, it's like you said, I've been keeping an eye on the market as well myself a little bit, even though I'm more in the multifamily spaces. There's so little inventory. There's just so much competition. People still want to buy houses, and people haven't been hit economically yet. I don't think it doesn't seem like it at all.
Yeah, most of the property managers I've talked to, they're saying they're collecting like 90% of their rents on time, and they haven't really seen an effect there. I don't know what you've seen. That's what I'm seeing personally with my stuff. But you're right. I think whenever this like temporary lift from the government kind of subsides, that'll reveal kind of what's going on because I don't know, it's easy for me to be optimistic and bullish, but at the same time, I know plenty of casino executives that aren't working now that used to. Those are like high end management jobs. They're not like your hourly jobs. So I don't know. It's a really, no one's seen this before, so it's kind of hard to predict, you know?
It really is. It's just so much unknown, like you said, and it just depends how many people. I think I heard that at one point we had something like 33% unemployment here in Nevada, which is just crazy. It's crazy,
Yeah.
crazy, crazy levels. And you've just got to think, even at the best case scenario, how many of these people are going to go back to work? Even if we settle at 7, 8, 9% unemployment, that's still more than double what we were sitting at before. So,
Mhm.
but who knows, right? You never know. There's just so many factors. The government is pumping in trillions, and seems like they still have an appetite to do so. And you don't know how much they can put, how
Yeah.
much money can they print. I don't know. It's crazy.
Sure.
Yeah, it's hard to get your head around $1 trillion. A billion used to be an unbelievable amount, but now the trillions. So
Yeah. It's thrown around like it's nothing.
yeah, yeah, yeah. Now you also invest passively, or you have done, in a multifamily syndication. Uh,
Yep.
do you want? You mind talking a little bit about that?
No problem at all. Yeah.
Yeah.
So I invested with Grant Cardone. Some of the people who watch us probably know who he is.
Yeah.
So yeah, it's a syndicated real estate deal where he finds the properties. It's not a REIT, so I actually own a portion of the property physically. Like I own a really small percentage of the property. Um, the reason why I like those deals is because going back to what we were talking about before, it's extremely passive. In the investments I have, like the condos, those are passive. This is even more passive
Mhm.
because I literally just wire money and then that's it. It just spits money back to me every month. I don't have to spend any time looking at mortgages, looking at insurance policies, trying to find deals, processing my bank statements, any of that stuff. Like I don't do any of that. So the returns are good at 6% cash on cash, which is good, solid return for how passive it is. That's what you have to look at is how passive is it, right? Because yeah, if I'm doing all the work, that's nothing. I'm not going to want to do that. I'd want like 15%. But for the amount of work involved, it makes sense. What I like about those deals is the quality of the asset. He's able to buy these $100 million apartment buildings that someone like me, I don't have access to, right? I don't have the access to the capital or the lending or anything like that. So I like that for long term because I'm just a long term guy. I'm not trying to make money quick. I'm not trying to get rich quick. I'm trying to get rich for sure, as
Yeah.
Grant says.
I like that.
So yeah, he's able to buy really good quality stuff that is likely going to do really well over time. He gets really good debt on it. The downside to it is that even though I get a small tax write off from it because I own like a portion of the building, I don't get the debt pay down effect like I do on my own properties. So with my own properties, I have my own debt. My tenants pay that down over time, and I build up that equity. When I'm buying into grants deals, they're paying down the debt, and he's keeping that extra equity basically.
Okay. So let me just to clarify. So you get a 6% preferred return. Is that what it is? So you get 6% before Grant and his team get a penny. Obviously, they have to pay off the debt. They have to pay all their expenses. But after that, you and the other investors get not a guarantee. You get the 6%. And then after that, do you share in any of the other equity? So when he sells,
I can explain more. Yeah, it's 2/3. I keep 2/3 of whatever is above that, whatever returns I get above that.
Okay, so and then when they sell according to your ownership stake, do you get a percentage of that profit? Is it 2/3 of that, or how does it?
It's just a proportionate amount of the equity that gets sold. So he actually doesn't really sell stuff very often, but he does refinance the properties.
Yeah.
And that's why I like that stuff too, is because that strategy is easier to kind of do because you can force appreciation more with those types of properties than with residential properties. You know what I mean? And those get kind of advanced, but he's able to invest money into the buildings, raise the rents up so that they're worth like double what they were worth before. Because when you have debt on a property and you're able to raise the rents like just a little bit, it has a multiplier effect on your returns and the valuation. So he's able to increase the valuation pretty quickly, and then he can refinance the property, get the equity out, and then I get paid out a portion of that. And it gets complicated, but it's proportionate to basically how much I invested in the beginning.
Okay, yeah, and that's the great thing about multifamily, that refinance money, tax free. So when you get the, and yeah, just to dive in a little bit on what you said, just so that people understand, multifamily 5 units and above is valued on the income. It's something called NOI, net operating income. I know you know this already, but I'm just, for anyone who doesn't know, it's valued on the NOI. So it's the income minus the expenses, and that's what it's valued at. So if you're able to lower expenses, increase the income, you've just increased the value of that property, regardless of what's happening next door or in that area. It's not on the comparable, the market comparable scenario. So that's what Grant does. I'm sure he buys property that he knows he can increase the rent. He improves the property and maybe lowers the expenses and then increases that value. And he's able to then refinance, take some money out and pay investors like yourself that money, and you guys enjoy it. So and at the same time, you still get that 6% return. It really is such an amazing asset class. I think that not that many people understand and maybe know as much, more now than ever maybe, but still it's still an undervalued asset class, because you'll always have that asset. If you buy a good quality asset like he does, and you're able to improve it, that asset's always going to be there, and then you can take advantage of that. So it's such a great way. And plus,
that's underutilized strategy for sure. I think the main risk is just the fund manager, whoever's running it. You have to trust them, right? So you have to have some kind of relationship with them, because you lose the control. When I'm buying my own properties, I can control that. When someone else is buying them, I hope they're doing a good job and they know what they're doing. So yeah, you just have to look at that too.
Yeah, and that's one of the main things that people always talk about, is that more than the asset is you want whoever's running that property, the operator. You want to know who the syndicator is. You want to understand, have they got experience? Have they done this before? Are they trustworthy? Because you can have an average asset, but a great operator, and you're going to be a success. But if you have a great asset and a poor syndicator, well, you might be in a lot of trouble. So
yeah, that's a really good point.
Yeah. How did you find Grant? Just through his online stuff? Through his
YouTube? Yeah, a lot of sales things, and since I'm a salesperson, I kind of got connected with him that way. And then he shifted more into real estate investing as he, I guess, progressed in his career. So that's how I initially connected with him. And it's funny, when I was buying these condos, I was actually debating for a while on if I wanted to buy these condos or just dump the money into his fund. And I went back and forth for a while. He actually paused his distributions during the coronavirus thing, which was interesting. He, I don't know if I talked to you about this, but he stopped paying his investors for like 3 months, and people freaked out about it and they were upset. I understood it personally, because as an investor, I want him to protect the asset long term, right? I don't care about 3 months. I want to make sure that there's no deferred maintenance and that the property doesn't go to crap over a long time. So I thought it made sense. And then today actually, he just deposited 3 months of distributions in everyone's account. He was able to keep the rents up, and it was really good. But yeah, it's interesting, those little things.
Yeah, but I think that you're absolutely right. I think a lot of the top operators are doing that. I'm involved in Joe Fairless deal. I think I've spoken to you about that. Joe Fairless, I invested passively in one of his deals as well, and they did the exact same thing. And I listen to a lot of podcasts, and a lot of them are doing the same thing, and it makes absolute sense. The most important thing is to protect that asset, and to protect people's money in that asset. So by stopping operations for a few months, holding tight, seeing where things are, I also heard a lot of people are slowing down on renovations. They're not doing the renovations the same. They're just holding tight and seeing where things are. And that makes absolute sense because we had no idea 3 months ago where things were going. No idea. I think people were scared of May and June collections and even April. And I think they've been turned out to be a lot better than they are. So I think that makes absolute sense to do that,
Agreed.
So, yeah, absolutely. So seeing as you have 10 properties, there must have been some big mistakes or some big whoopsies along the way. Sometimes I know I've made plenty. Is it one in particular that stands out maybe for you, or maybe you've just been brilliant and you've made?
Oh yeah, that's a good question. Actually, really, I mean, this is going to be 10 when these three close, so I'm at 7 now.
Okay.
Interestingly, though, no, I've never lost money on a real estate deal. I think part of that is because I've been in the real estate business on my own as an agent, so it's really easy for me to have like a large. What's a better way to say this? I already have a competency around what I'm buying. I already understand the asset that I'm buying.
Yeah.
So yeah, I'm thinking, but no, I dodged a lot of bullets, man. To be honest, like I studied a lot before I got into it. Bigger Pockets has been huge. I think that's how we met initially.
Yeah.
I went on there, and I never over leveraged. I've done at least 25% down on everything. I haven't really bought really bad high crime areas. I've stayed in pretty good locations. I've paid really close attention to tenant profiles and what types of tenants live in what types of properties. You know what the number one thing is that I did that I think helped was right from the very beginning, I always understood how to extrapolate expenses and plan for expenses in like a worst case scenario.
Yeah.
So like most people, they're looking to buy a rental property. They say, oh, the rent is this much, the mortgage is this much, I'm good. Like I'm breaking even. It's like, no, that's not how it works because every 3 years, you're gonna have to do this, and that's gonna cost this amount. You're gonna need a new roof. You're gonna need new paint. And I understood from the beginning, I guess, because I'm a math guy, like how that works out. So I was just always extremely pessimistic, I guess, and I planned for worst case scenarios, and luckily that's worked out. So yeah,
That's
I've been lucky.
yeah. Well, I'm glad to hear that. That's great. You've had so much success, but I think that's a big mistake that I see a lot of people. I saw on it was Bigger Pockets on Facebook the other day. A guy was talking about that he was buying cash and the rent was 1,400, so he was going to pocket 1,400 a month. So that was great cash flow. And then
Yeah.
I try to explain to him that no matter what, you're going to have expenses. You want to allow for a property manager, you want to have allow for repairs and maintenance. You're going to have stuff just like you said, stuff's going to break. You can't just own property, especially rental, because for the most part, even if you have good renters, they're not going to take care of the home like you take care of it. And they're going to expect, they're paying that rent, they're going to expect the place to be in tip-top shape. So yeah, that's a great point. And another thing that people I think miss is just having some kind of reserves. If you're able to, if it takes 20,000 to buy or 40,000 to buy a property, that's all they think they need is for that down payment and those closing costs, and that's it. But if something happens within the first week, I had in one of my properties a leak within the first week. Now, luckily, I had home warranty on the property, so they took care. It was a water heater, and they took care of it. But that was if they hadn't, it was $5,000, I think, to fix all of that. And luckily, the home warranty, and I think the insurance covers some of it. But if you don't have that reserves, you can get in a lot of trouble really quick. So I think that's such a great that people need to be aware of, understand the expenses, and have some reserves.
Yeah, and speaking on that, just really quick too, one other thing people underestimate, I think, is the cost of turnover. So if you lose a tenant for a month, that's a huge turnover, especially if you have debt. Like you're talking a significant amount of money. So one thing that I do is that I try and not overcharge my tenants. I usually offer, at market or like slightly below market rents. And I'm not aggressive in increasing them because in my opinion, the turnover cost is just way higher than and the risk of getting a bad tenant when you have a good one. Like a good tenant is worth its weight in gold. It's a little different with multifamily. You have multiple tenants, but with single family, yeah, a good tenant is worth their weight in gold. I have one person, that first property I bought, they're still in there. They've been in there 5 years and just on time every month and never asked for one thing to be fixed. And it's like perfect. I'm sure there's stuff that came up, but they just take care of it. So yeah, I'm not aggressive in raising rents. Now, if I have a vacancy, then yeah, I find someone new, I go up to market, and I'll creep people up if it's been a really long time. But I just think people underestimate that risk factor of trying to find a new tenant who will pay an extra 25 bucks a month. And then you have someone that just trashes a property, they're paying late, you're dealing with evictions, you're dealing with repairs, and then paying a mortgage while there's no one there. That stuff adds up super fast.
That's so true. And there is a return on peace of mind as well. If you have
Yeah.
good tenant in there that's giving you no hassle, there's a lot to be said about that. Just not having that stress of having to deal with a bad tenant or all kinds of issues. There's a lot of value in that as well. So yeah, some great points there. So before we stop this, I don't want to keep you too long. I know you're extremely busy. Was there anything else you think people would like to know, or anything we missed on or didn't touch on today?
No, I think we covered it. That's a pretty good conversation. I always enjoy talking to you about it. But
Yeah.
yeah, for me personally, my thing lately has just been trying to decide how passive I want to go with syndicated deals versus my own deals.
Mm-hmm.
That's been that I'm interested to hear your thoughts on that too. But it just has, I guess, what it boils down to is how much is my time worth outside of real estate investing and where I'd rather spend my time. But there is a lot of upside to your own deals because you own an asset, you pay down the debt, and now you 4x your money basically if you're putting 25% down.
Yeah, absolutely. Your tenant's paying down your debt for you. It's unbelievable. And the great thing as well is that not the great thing, sorry, but the great thing about the real estate is with we're most likely heading in for a good amount of inflation right in the future. It might not be anytime soon, might be 10 years down the road, I don't know, but that inflation is going to eat away at your debt. If you hold it, say you buy a property today and you hold it for 30 years, well, that debt in 10, 15 years time is going to be worth so much less. 30,000.
That's really good point. I never thought about that. Yeah.
$300,000 today compared to $300,000 in 10, 15 years time won't be the same. And you'll be paying down that debt with, you'll be paying down that debt with today's money. So
Right.
that's,
When you're talking 30-year holds, which for me I am, then inflation is certainly a factor. Like it's a huge factor. Think about 30 years ago, 1990, what a dollar was worth compared to now, what gas prices were, all that stuff.
Crazy. Yeah, it's incredible. Yeah, it's incredible. So yeah. Well, congratulations on all your success.
Thanks, man. I appreciate it.
Yeah. I know you work extremely hard, so it's definitely well deserved. Before we go, where can people find you if they're looking for a well-dressed, good-looking realtor in Las Vegas?
Yeah, so probably the best place is since a lot of the viewers might be on Bigger Pockets, I'm on there on the forum, so you can just find me, Dan, last name Mumm, M-U-M-M. And then also probably my Zillow profile. If you're looking for homes, you can find me on there too, or just find me on social media. But Dan, D-A-N-M-U-M-M is the name.
Cool.
I'd be happy to help or just give advice or anything. Any way I can help.
Yeah, absolutely. Cool. Well, I'll include that information in the notes so anyone looking to find
that'd be great.
There. Yeah. As always, it was an absolute pleasure. I love, we like to talk in text a bit and talk about real estate. It's nice to see you in person, not over text. So thank you so much for taking the time today to do this. And I really enjoyed our talk.
Me too. Thanks, Barry.
Thank you.